Okay, so I think I might be live. Well, I'm meant to be live anyway. Let's have a look. Yeah, that's me. Okay. So I think I might be live. Well, I'm meant to be live anyway. Let's have a look. Quite trippy. Yeah, that's me. Okay. Just see how I can get any comments. Suppose they'll show up in this chat here. Okay, so today I'm going to be talking about my stock market holdings and what stocks to buy right now. Let me just get rid of this. Okay. So first thing I'm going to do is just log into my Morningstar account and have a quick look at my portfolio. Unfortunately, I have underperformed the market this month. Let's bring this up a bit so maybe you guys can see me a bit better. I don't know if you want to see my face anyway. So this isn't all my portfolio in here. These are just, so basically I kind of have like a legacy portfolio in Hargreaves Lansdown. And then I have my current portfolio, which is in DEGIRO. So these aren't all of my holdings, but it's pretty much about 75% of my portfolio. Sees 22,000 overall. I have around 30,000 invested. Also in here, I haven't included my fund. So I have the Buffetology fund and then just an S&P 500 tracker. So I thought what would be a pretty cool idea to do, or maybe a good idea, would be to have a look at some of my holdings, look at the rationale behind those holdings, but also to have a look at which ones that maybe I would be buying now. Now, one of the biggest stocks that I've been buying over the past month is Altria, which is an American tobacco company. Now, one thing worth discussing with Altria straight away is maybe some of the ethical issues around it, being that it's a tobacco stock. So a lot of people who I've discussed Altria with have turned around and they've said, well, I'm not comfortable investing in tobacco stocks because, of course, tobacco kills people. Tobacco also is a strain on the health system. And, I can't disagree with any of that. But for me, when I'm investing, my kind of rule or my ethical line is something that I like to call the harm principle, or something that is called the harm principle. So I will invest in a stock as long as that what that stock kind of operates in doesn't harm other people. Now, I know what you're saying. Well, of course, Altria harms other people, but the key element here is choice. So I think that people choose to smoke and they should have the freedom to choose to smoke if they wish. And especially in the UK, they pay a lot of money in tax. And from the studies that I've seen, they pay more in tax than they do take from the health system. So I think, if people want to smoke, then that's their choice to smoke. And when I draw the line, for example, I don't invest in arms companies, for example, Lockheed Martin or anything like that, because I don't think people choose, to be involved in wars and conflicts. And that's something that I'm not really comfortable investing in. So first things first, let's get our head around Altria and why I think it's a buy. Now, one thing to note, if you go on Morningstar, you'll see that Altria has a 5-star rating at the moment. Well, I don't particularly pay super close attention to the Morningstar ratings, but it does have a bearing. So why am I investing in Altria stock? So I was invested when Altria was at a 7% yield, which in the current kind of interest rate climate in the UK is an absolutely insane dividend yield. It's dropped a bit because the price has gone up, but I think you'll find it hard pressed to find a better yield for the safety in the market. So let's take a look at the ratios then, and let's have a look at how Altria has been performing and what specifically I've been looking out for. Okay, so first thing that I like to do whenever I look at a stock, and I'll use the same thing for Altria, so you guys can have an idea of how I do it, is I look at the margins. I only really invest in stocks that have very juicy high gross and net margin. If a company has a high gross margin and a high net margin, this is usually an indication that the company is benefiting from some kind of economic moat. So what does that economic moat mean? Well, if you do any reading on Warren Buffett or any economic knowledge, it basically means that the company can defy one of the key rules of capitalism, which is that excess returns or excess margins, if you like in this case, they will get competed away towards the cost of capital. So, for example, breaking that down into kind of layman's terms, if you like, that say someone is selling apples, for example, and they're making 30 pence profit in every apple that they sell. Because that's a nice margin, someone will come in and they'll be happy to make 20 pence. Someone else will come in, they'll be happy to make 10 pence. Someone else will come in, they'll be happy to make 5 pence. So you see, as the competition crowds the market, you know, those excess returns, that 30p reduces eventually to 5p. So that's one thing I like to look for, is that the company, if you like, can maintain this 30p Apple margin, if you like. So definitely Altria is one of the companies that benefit from this. And that is evident from their very well stable and growing gross margin figures here, and of course then their net margin figures here, which are incredibly impressive. So that's the first tick then. You know, this is a company that has high net margin, high gross margin, and has maintained those margins over time. But we know that one of the most important things with stocks is that they operate incredibly high free cash flow. I like to see companies that produce a lot of free cash that they can pay to shareholders, or they can invest in other activities. So one of the first things that people tend to do is they look at the cash flow as it appears in Morningstar. But personally, I don't use it. I much prefer the FT Markets version. So not this one here. So if we just load this up here, and I'll show you then how I calculate free cash flow. See if I've got any Sponking in a Fortnite gameplay. Oh yeah, you wish. Fortnite gameplay. Don't play Fortnite. Okay, so we're gonna have a look at the financials here. And we go into cash flow. So the way that I work out cash flow is, well, call it arbitrary if you like, but this is the way I like to do is you take the total cash from operations this year. So for 2018, that's 8.3. And then you take the capital expenditures and minus the capital expenditures. So these are in terms of millions of US dollars. So you can see that Altria has an extremely healthy cash from operations here. One thing to keep an eye out in this total cash from investing activities here, you can see that Altria has taken a massive hit this year due to investment activities. Apologies, and we know that those investments have come in the form of Juul, in the form of also a cannabis company. So that's something to keep an eye on, because that does materially reduce free cash flow. But as I would count that as a one-off. It's not something you want to pay too much attention to. So you see that the total cash dividend paid here is 5,415 in terms of in millions, remember. So that shows then that if we minus the total cash from operations and the capital expenditures, let's actually do it then. Get the calculator up here. So if you go 8391 free cash flow here, minus the capex of 231, and then we minus the dividend, which is where did the dividend go? Capex, issue return stocks. Capex, total cash dividends paid. It was highlighted the whole time. 5415, and we see that in terms of millions, that Altria has 2,745 cash flow, which is extremely healthy. And this is cash then they can either choose to pay out to shareholders in the form of special dividend, or that they can choose to invest. We see here, you know, that they have gone and used that investment quite substantially, so that they've had negative free cash flow for this year. But that's something that we're aware of, that we understand from the financial report, and that we're very confident with. So one thing that I would say is worth keeping an eye on here is where this money has come from. Where is this additional investment money come from? Now, I personally don't like it when it comes from the issuance of stock. So if this wasn't in brackets here, I wouldn't really be happy, because when a company issues stock, that reduces my holding in the company. That reduces the amount of that company that I hold and that I own. So I don't like it when this is a positive number. As it's a negative, we know that Atria is buying back stock, something that I'm very happy with. So we can see here, evidently, that this has come from the issuance of debt. With so much free cash flow, that's something that we're not going to be too worried about. But one thing that is worth taking a look at there then is the interest coverage, and exactly how that debt is being issued. Is that kind of high interest debt? Sorry, is that bonds? And the only way to do that then is to go and to take a look at the is to go and to look at the company's reports. So we go Mo Investor Relations. So what we definitely want to be looking at here is the events and presentations, because we know that this has recently happened. So we want to look at the, there should be an item here where they discuss particularly the, that they discuss the issuance of the debt. So let's have a look here. Just bear me 1 second while I, maybe it's in press releases, while I look for this. Here we go. Atria makes 12.8 billion minority investment in Joule to accelerate harm reduction and drive growth. So this is what we want to look at. We want to see now, are they going to cut the dividend because of this investment? Are they going to issue very high interest in debt, or how exactly are they going to deal with this? So here we have the overview. You should really, as an investor, prospective investor, read all of this. I have read it. So what we want to see is how they're going to raise this money. So financing. Okay. Atria financed Joule stock purchase through a 14.6 billion term loan facility arranged by JP Morgan and Chase. 1.8 billion of the facility remains undrawn and may be used. So it's nice to see that they got a little buffer here. So we know that that's come from a loan facility with JP Morgan and Chase, but that is something then that we have to do more research on to see exactly what the terms of that was. So how are they going to be paying for this? Well, this is the key kind of point here. Is Atria announces a cost reduction program designed to deliver approximately $500 million, $600 million in annualized cost savings by the end of 2019. So this program will include, among other things, reducing third-party spending across the business and workforce reductions. Atria expects this program to offset most of the interest expense associated with the debt incurred to finance the Joule and Kronos Group investments. Okay, so now we see that it's been funded by JP Morgan, and how are they going to be paying the debt back? Well, through this cost reduction program to pay the interest charges. So this lets us know now as investors, our dividend's not going to be affected, and the free cash flow that's left at the end isn't going to be materially affected, because this is going to be offset by cost reductions. So that's ideal. That's something that we like to see, something that we're happy to see. So now that we're comfortable with the margins, now we're comfortable with the free cash flow and the debt and how the company's moving forward, one of my favorite metrics to look at is under efficiency. Sorry, not under efficiency ratio, under profitability ratio. I clicked the wrong one there. Once the load, while it loads, maybe I should take a look at any comments coming through. I don't know how to do that. What is this here? Hello, Pranam. Yeah, Shumai, Chris, how are you? How's school? Right then. So we have a look here. Apologies, I've covered my face now. There we go. So one thing I really like to look at, as opposed to the gross margin and the operating margin, is the return on equity, or I prefer even again the return on capital employed. Quite simply, the higher the return on equity, the better. Any material reduction in return on equity, there's something that lets us know that the company is becoming less profitable from the money that it's investing to grow its operations, or the money that it's raising through equity. So we see here that at the beginning of 2013, it had a return on equity of 124.47. That's peaked 2016, and there's a drop off in 2017. So this is something we need to take a look at and something we need to investigate. But the 2018 figures are fine. So if we look then at the financial health of the company, just as kind of a, how can I say, just as a kind of double check, then we can see that the debt is easily affordable. There should be here a interest coverage ratio. Let's have a look. Can't quite find it. So just while I'm here, one thing to note with a quick ratio here. A quick ratio of under 1 like this is usually extremely worrying, because it means that a company doesn't have enough current assets to pay off its current liabilities. So this would usually be a huge worry here, but there's nothing to worry about. Basically what happens, because Mo creates cash so quickly, there's something they don't need to worry about. So sorry, I can't find the interest coverage ratio here. You can work it out yourself by taking the interest expense from the profit and loss statement and comparing that then against, it's up to you how you want to compute it exactly. I like to use the free cash flow figure. Some people like to use the profit figure. It's totally up to you. So that's one of the investments then that I've been buying heavily over the past month. So what I'm going to do now is maybe take a look at one more before I end the stream. The stream, I'm going to be trying to just do the stream every, I don't know, once every week, maybe on the weekend. It's nothing serious. I know not a lot of people watch, but it's just a bit of fun. It lets me as well take a look over my investments and see how they're doing. So let's head back into my portfolio. And actually, maybe here I'm going to talk about one that I've gotten wrong. Let's talk about Card Factory then. This is something, guys, that I've really not messed up, but something that I should have sold a lot earlier. Something that I've been too laid back and too chilled with while I'm collecting the dividends. I've had a ridiculous amount. I think it's on a £1,000 investment. I've had, I think, from this stock maybe £140 worth of dividends. Something ridiculous like that. That's materially reduced my my exposure. So you can see this year that has outperformed the FTSE, but because I made a very poorly timed purchase, my my average cost for Card Factory shares is around 230 odd pence. So what went wrong? What can we learn from my bad investment in Card Factory? So firstly, let's take a look at the financials and the ratios, and let's see why I bought Card Factory shares to begin with. So everything looks good on a, let's go to our ratios. Everything looks good on a kind of like an overview of this company, but I'm going to show you the problem in a bit. So first things first, what do? We go and we check our margins. So we have an operating margin, 22%, 22%, 23%, 18%, which I like, which is very healthy. We're not talking about 1 or 2 or 5% margins here. We're talking double digits in the 20s. Brilliant, something that I'm happy with, and high profit margins also. And we can see here, very healthy for a card shop. There's something that just sells pieces of cards. A return on capital employed, my favorite metric, which has been touching the 20s for the past 5 years, bar maybe a poor year in 2015. But these things fluctuate. As long as the general trend is healthy, we can rest assured and we can remain happy. So we can see now that it's got very solid. It's got very solid operating margins, and it's got a very solid return on capital employed. So what should we do next? The next thing that I like to do is I go straight into Financial Times and I look at Card Factory here. So look then. And we're going to look at the free cash flow, my favorite thing to do. Why do I look at free cash flow then, not profits? Because of the accruals concept in accounting means that things that you book as revenue or profits, it doesn't necessarily mean that you've had that money back yet. One way to look to see if a company is trying to artificially increase revenue through accounting tricks is to check the account, is to check the accounts receivable. So if the accounts receivable are going up as a percentage of revenue, I'll show you how to do that later, then you know that this company is trying to increase revenue through offering more favorable terms to buyers, something that maybe shows weak demand for the product, something that maybe shows a lack of an eroding economic moat. So again, so you have the margin figures here, but we want to go in here to the cash flow statement and let's see exactly what's going on here. So you see here total cash from operations of 73 million, and then 30 million in capital expenditures, 60 million pounds worth of free cash flow. Brilliant, very attractive. 72 million then the prior year, and so on. We can see here that this is a company that takes a lot of money in from operations and spends very little in capital expenditures. The type of companies we really like, or that I really like. So we can see here that there's a 60 million pound shortfall here between the free cash flow of 60 million and apologies, and the total cash dividend paid. So where has that come from? Well, that's come from issuance of debt. Now we can see that there has been some stock issued here, but it's in such a small amount we can be confident, or we can be pretty sure that this is more likely from stock options as opposed to an issue. Okay. So we can see here that it's taken on 20 million pound worth of debt. If you do your own research, maybe, okay, we'll go do it now. We can see that it has a very strong balance sheet. It's something that's really not worth worrying about. We can see that as total assets of 447 million, and then its total liabilities 228 million. So if we want to take a look at the current ratio, then we can see, where are we here? We have our total current assets of 72 million, total current liabilities 65 million. We can be confident that this 72 million in current assets is enough to cover the current liabilities of 65 million. If you want to be really conservative, you can take out the inventory figure here, which would mean that the quick ratio then, or the acid test ratio, falls well below a healthy rate. But again, we know that Card Factory generates a ton of free cash flow, and that's all it would take for them to pay back that debt, would be to not pay the special dividend, the silly special dividend that they pay. Again, I'm talking very generally about these shares now. Before you buy any share, you should look at the historical annual reports. I like to look 5 years, but minimum 2 years or 3 years, in my opinion, you should be looking at before you make a decision to purchase a share. So what went wrong? What's going on? So what we want to be doing then is, if we go to our Card Factory Investor Relations, then Card Factory Investor Relations. Oops. Now we have the annual report, which takes in the 4 quarters of the 2 halves, as it is in the UK, and they give you the overview information. But for us to really find out what's happened to Card Factory's share price over the short term, we need to be looking at the half-year report. So let's take a look at the annual report in Comfort 28, but also the half-year report here, because when this half-year report was published, the clues were there. I was naive and I ignored the clues. So let's take a look at the half-year report. We'll go in the report format, and I'm going to show you now how they've kind of where I was silly, basically. So we can see the revenues increased. Like-for-like sales have has declined by 0.2% here. But again, the underlying profits remain healthy. So this stall here, this is a bit of a worry. This is a bit of kind of like a niggle, because this shows you now that the company is slowing down its like-for-like sales. But personally, I'm not that worried about like-for-like sales, as long as the company keeps spitting out cash, because it has a low PE ratio, has a very low valuation. This is not something that I'm really concerned about. So what I want to look at here is the margins. So there should be a bit in here on margins. See if I can get it quick here. By the way, Getting Personal, absolutely terrible company. Subsidiary, sorry, let me have a look now. There should be a bit in here on margins, if I could just find it. If not, we can work it out. So here we can see that the underlying margin, I don't really like to take EBITDA, but we'll go because it's a video. I want to be quick. I want to show you quick. So the underlying margin EBITDA margin was 16.1%. We can see in full year 18 it was 18.3%. Again, this is showing pressure squeezing. Again, we're talking this is where we have to worry now, okay? Because you're talking about margin pressure due to the fall in the value of sterling and the US hedges here, okay? So whenever a company is talking about declining margins or compressing margins, it's time to worry. They try to bat it off and give excuses, but any decline in the margin is a clue to you as an investor that there is trouble ahead, that there is a competitive force or a lack of control and cost that's hurting your investment. So here we go. So where are we? We have a margin here, underlying EBITDA here of 22.3% as compared to full year 17 of 24.7%. Again, something we definitely want to be worried about. So basically what's happened, if you go in and you read the annual report, we'll go into the annual report then quickly. And hopefully we'll have some more information about here and the sales mix. So if you go on, again, it's really difficult for me to find these things on a live stream. Maybe I should prepare them beforehand next time. It's really hard to get through a 117-page document while on a live stream. Whilst margins were impacted by the prevailing foreign exchange and national living wage headwinds already identified by the margin mix impact. So what they're talking about here about the margin mix is when you're selling products, you might have some high margin products, some low margin products, and you combine them and calculate then the sales that's come in, and you can work out kind of like a margin for the combined sales. So basically, the story about Card Factory, what's happening with Card Factory is that the revenue is flat or increasing very slightly, but the quality of the revenue is far less. So they're making more revenue, they're getting more money in from lower margin products, and their margin on their good margin products, the cards are being squeezed. Now, if you think about it rationally, and I maybe wasn't thinking about it rationally, it's quite obvious that Card Factory is always going to find it very hard to pass on increases in costs and administrative expenses to the customer. Now, why is this? Apple do it very successfully. So why is Card Factory having such a tough time? Think about it. What is Card Factory known for? Card Factory is known for selling cards at 29p, 59p, and 99p. It's very hard for them to push the 99p, the cost of the 99p card up to £1.9. It's very hard for them to push the 29p up to 39p or 49p because their whole business has been based around the value proposition. The whole point people go in Card Factory is to buy a 29p card, a 59p card, or a 99p card. So it's not known for having high prices. The main selling price is the main selling point is the price. So a lesson that I would take from this, a lesson I would learn from this is to avoid buying shares in companies who are only known for price. If a company is known for its price only, it's a red flag. You maybe should avoid those sorts of companies. So here we go. We can see here then that SOAR wages have increased from 17.3% worth of revenue in 17 to 17.7% worth of revenue. There's that squeeze. Okay, they're trying to save this here on the property costs. That is good. That is a good point. But as you can see, this was the killer blow here. The cost of goods sold has gone from only 30% of revenue to 32% of revenue. So we have two headwinds here. We have an increase in the cost of goods sold, which is showing us that what they're selling is at a lower margin. And then it's also showing us that the store wages here is that further squeeze. And again, we have another in the UK minimum wage increase coming in April, which is going to further squeeze that margin. Okay, so I hope that kind of clears up Card Factory. So I've cleared one thing that I'm buying, or discuss, sorry, one stock that I'm buying and one stock that I'm looking to sell at the earliest reasonable opportunity, and one stock that I've been quite naive on, to be honest with you. So before I go then, I'm going to have a quick look at the comments, see if there's any sensible comments for me to answer on this stream here. No, nothing. Okay, so I hope you enjoyed this stream, and I hope you got something from it. I'm going to be streaming next Sunday around the same time if you want to tune in and watch, and hopefully we can maybe have double-digit viewers one week, maybe 10 viewers if I'm lucky. So cheers for watching. Thank you very much. Bye.